Yeah.
Yeah, likewise. Before I hit go live, we were just talking about the economy and how people seem to, in recent times, been a bit scared. I know from what I've seen from investors over the last few months, it's been a panic about inflation. Anything in the podcast feeds that had inflation in the title featured in like the top episodes in the country, even if they weren't like about that, like they weren't very insightful. And now we're seeing consumer sentiment, everyone getting really scared about interest rates rising and so on. It's been a heck of a year, mate. And this is just a natural segue into what we're talking about, which is like the financial year in review.
Yeah.
Yeah, I don't know. What are you seeing at Pearler? What are you seeing from your investors and from your users?
Yeah. So I think it's in two kind of camps. I think there's a number of people that I think would have been regularly investing, like really buying into accumulation, and they're sort of sitting there going, probably sitting on the sidelines. So there's probably, we think maybe 20-30% of people are just gone, I don't know what's happening. I know I should invest, but I'm just going to sit this little bit out, rightly, wrongly. And then for the most part, though, we've seen, a lot of accumulation. I wouldn't say it's like buying the dip, but, heavily skewed towards buying indexes. Like, I think there's definitely an idea of, I can probably pick good stocks in an up market, but if you buy a stock in the down market and then the market rebounds, the chances of buying the stock that then lags the rebound, it's like a new style of FOMO, maybe.
Yeah, I see that too, because there's like people who like, so there's like dollar cost averaging, which is, it should still be going, like autopilot, as you know, auto invest. Actually, in the blog post that I wrote for Pearler a couple of days ago, I spoke about how powerful that is, because you don't buy the dip, right? You just keep buying. That's the whole point, right? It's more like anchored to your personal finances, and then you just keep accumulating. But then there's the people who, for whatever reason, they also invest in individual shares or whatever, when they try and be a bit more, I guess, creative or shrewd with their decisions. And what I've found with those people, and I'm in this camp too, is that all of a sudden people are questioning, well, now valuation, now my research is more important, because, in an up market, a rising tide lifts all boats, so to speak. But now we're seeing people have to focus on some things maybe that they overlooked in the past. I don't know if that's fair,
Yeah.
but
Do you think it's changing what people are looking for? So I think anecdotally, I think one of the key themes for first-time investors over the last couple of years is this idea of buying companies you love, or buy companies you use the products for. And what you're talking about there, that shift of focus to, well, what are these companies that are going to maybe have more defensibility in an inflation environment or a recession environment? They're kind of two quite different things. So I don't know, are you seeing more questions around, well, what should I be investing in that's likely to be more defensive in this environment?
Definitely. Yeah, actually funny, I've got a book here. Peter Lynch, One Up on Wall Street. This is like the Bible to a lot of investors, particularly newer investors. Yeah. They look at this book, and one of the principles is how to use what you already know to make money in the market, right? More than 1 million copies sold. I'm surprised it's not more than that. And that's what people do. It
looks like a pretty old version, though. Maybe he sold a few more since then.
Yeah, maybe he sold a few more. It's showing my age now, mate. And so, yes, is the answer. Like, particularly when a lot of newer investors come to the market, it makes sense that you would stick to what you know. It's more comfortable, right? Whether it's an ETF or whether it's an individual share, you're going to stick with what you can understand, or at least that's probably good practice. And now people are asking the question, well, hey, maybe Woolworths, your supermarket, we all need milk and bread. Coles, Wesfarmers that owns Bunnings. So we're seeing those questions more. Whereas maybe last year it was, which tech stock is the most interesting that I can kind of understand. Yeah. And those have been really punished, and people's, I guess, patience and risk tolerance has been really tested. So yeah, I mean, you and I jumped on this call today just to kind of like have a chat and to reflect on the year that's been. One of the things that's interesting, right, I love this. It's like the Spotify Wrap, the Pearler, like year in review. this year you've categorized everyone. Maybe I can share my screen if I can bring that up on my thing here. You've categorized everyone, and you've basically put them into like these categories of what kind of coffee or what kind of espresso are you. So here we go. You've got chai, you're really chilled out. Only 10% of Pearler users, if I can bring this up alongside us, 10% of folks fall into this camp where they only check their portfolio once a month, 20% 5 times. That's the flat white. That's where I am, by the way. Thank you. 40% are in espresso and 30% are in espresso martini, which is pretty dangerous on a night out. You're checking it at least every day.
Well, it depends. It depends, I guess. I think the point of all this is to have the conversation, right? Because, checking your portfolio is not in itself a destructive behavior if it's not stressing you out. And maybe if you want to think about it a little bit more philosophically, in this age where we've got so many distractions for taking us away from life, checking your portfolio might fall into the bucket of just another social media, right? So it really depends on your relationship. This is a bit of fun. The average across the entirety of the community is about 22 times a month, so once a business day. Now there are people way up there, people way down. You're probably quite a methodical person, and I imagine you use multiple apps actually. But is there some rhyme or reason for you? Do you say I'm going to look at my positions once a week at the same time, same day every week, or it just happens that way? Well, how do you even think about that as someone who probably is managing a range of different things, ETFs, stocks, what have you?
That's a really good question. And I would say the answer is it's changed over time. So when I started, I was just like everyone else. I would be at the top of your list. I would have checked 10 times a day. And I think one of the reasons for that in the early days is obviously I was young and I didn't have that much money. So any money that I had in investing was like really sensitive to me, and it was new and exciting. But I also had invested my mum's money. So I was extra scared, and I thought, well, I need to have even more eyes on this just in case, right? And what I've since realized is that for me, constantly checking my brokerage account is not healthy. So I realized that for me, the best thing I could do would probably be to separate basically how I keep up to date with my news and what's going on and what's actually in my account. So like one of the things that I can do is like I can just get alerts on my phone, or I can keep up to date in other ways. And that's been really healthy for me. See, auto invest, which Pearler offers, which is awesome, was never around when I was starting out. If it was, that's the thing that I would have done from day one, because I would have had that just playing off in the background. But yeah, I'm the type of person that if I check too often, I feel like I might be tempted to make a move.
Do something.
At least there's that old saying, right? No, I wrote this in the blog, which is don't just do something. Don't just stand there, do something, when it should be the other way around. Like we should be just standing still and just having our methodical investment strategy playing out. I don't know. That's kind of my
real balance, right? Because I think in the early days of Pearler, when we were thinking about how to play in this space, which was not just about share trading, it was about wealth building, right? So I think I read something way back that on average, people are still looking at their net banking on their phone or whatever once or twice a day. Maybe it was once a day. And so I think there's something probably we can't fight, right? And maybe it's a positive thing. You're saving, you're investing, you own it. And yeah, it feels good just to look at the fact that you've done that. Now, I think what that plays into for us is, well, it might be okay to look at it, but let's not make it stressful. So, there's a lot that goes into how to focus on the whole pie rather than what the pie is relative to yesterday, I think. So it's I don't know if you can really, we wouldn't certainly put the coffee thing out there thinking, oh, you need to rein it in. I think it just is a reflection on, is that good for me? Am I managing it?
Yeah. As you were saying that, I was reminded of this idea that as investors, we tend to we tend to set like goals in years. So we might set a goal in 5 or 10 or 20 years. But we measure the results daily if we look at our phone and if we look at the latest, net worth or whatever. And there's a mismatch there, right, between the long-term goal and the short-term checking. And we see that play out in finance in all types of ways. We see it with company reporting. So we expect long-term returns from good companies. That's what most of us say. And yet we get quarterly results. And because you run a business, I run a business, how hard it is to do anything in one quarter and then all of a sudden look like a genius or you've done so well. So I think that's one of the things too, where we're kind of like, we need to just check ourselves at the door. Like, what was the average goal, like financial independence goal inside Pearler?
Yeah, so somewhere around 1.5 mil. So but for those who aren't so familiar, our platform and experience is based in goals. So that's the whole reason we're doing this, right? One of the main goals is financial independence. Very simple. My dividend stream is going to outpace my OPEX, my daily expenses. And so people are working towards about 1.5 mil. It's a great debate to have. What's your number? Is it 1.5? Is that enough to kind of be looking at the 4% rule? Is it 2.5? Are you going to move somewhere super cheap to live and check out completely, or are you going to take that part-time job you always wanted? I don't know. I mean, it's interesting though, but we just did a survey as well. And I think something like 92% of Pearler investors were putting money away, knowing that they're going to leave it there for at least 5 years. So that's
pretty good. That's
a huge
92%.
Yeah. And I think something like 40% were expecting to leave it there for a much longer period, like 10, 15 years. Yeah.
Okay.
I think that's, you were asking about goals before, and it's really interesting because it sort of creates the question, is it more important to have a really defined goal with a really defined time frame, or at the fundamental thing, have just a minimum time frame and go, no matter what, life might change, goals might change, but I know that I'm going to be able to hold this for 5 years or whatever the time is. It kind of maybe frees you up from the stress of, am I going to get there or not?
I'm the type of person that does not like the specifics. I like to know that I've got a general goal and I'm going to work towards that in the best way I can. But I don't know, I find that if I'm tracking it too closely, like say I used to do this in a spreadsheet, I'd get really down on myself if I didn't meet my goal or whatever. And so I just gave myself a little bit more leg rope, and I find psychologically that really helps me out. I don't know, how has that evolved for you over time?
Oh, look, for me, there's a lot of changes that happen when you jump out of corporate life and into a scale-up startup business, right? That requires capital to live. So I would say personally, and for my family, and it's a much more general thing, right? And it's actually driven a lot more by life stages rather than purely financial. But I think as you were chatting, what I was thinking about there was there's about 45 to 47% of people with active auto invest. There's two interesting things, right? The people who don't have auto invest are actually showing almost exactly the same behavior as the people with auto invest. So they're investing at the same frequency, about once a month, logging in about the same, about that 20, 22 times a month. So it's not that drives the behavior, but what's really interesting is you were talking about long-term goals and specific goals. One of the most popular kind of ways that people make use of auto invest is this concept of like reaching a benchmark. So, and most typically it's $1,000. So for those who aren't familiar, it's like this idea of once my cash account hits 1,000, buy the thing, whatever that thing is, whatever that share is, ETF, whatever. And there's no time frame on that. And it's just this $1,000 increment that could take you get some extra money, you sell something on marketplace or whatever, and you put it in there, you've just hit your 1,000 in 2 weeks. It could be 6 months. And we've found like that's driving off some books and things that kind of revolve around this idea of $1,000 project or even 1,000 share project. That we've seen really popular with people who need something to keep them engaged. And it seems to work, to be honest.
Is there? So you'd say that's really interesting. I would have thought the people that are using auto invest would be slightly different, because I thought they maybe would check less. But I guess the thrill of still having that is like you still want to feel that reward of, oh, look, it's now invested for me or something like that. I guess it's the same. It's just logging in, right? Has it changed over the past year, given this is like a financial year in review, with micro? Has it changed?
Look, micro has quite a different behavior, but I think 18% of our customers are using micro and shares. So they kind of probably have a side goal for micro. And I wouldn't say that micro has a very different behavior. I think people probably check less if they've just got a micro account from our information. But no, I mean, I think, what we've seen is we've got this pretty even spread of earnings, right? So I think mid-teens earn less than 45 grand. So they might be in casual job. And then, 45 to 80, 80 to 120, over 120, like they're all in the 20s to 30%. So it's kind of even spread. So we're not dealing with super wealthy people or people who are just starting out in their careers and earning early wages. And they just find a way to invest. So micro's made that even easier. But I think the most amazing thing about it is, like, no matter what salary people are on, they're finding a way to squirrel away something. And I think that's really cool. It's a very, very real life example of make your lifestyle fit your earnings.
Yeah, I like it. One of the things that I put in the headlines for this was 5 money lessons, 5 timeless money lessons. And I brought some books into the office here with me. Obviously the one up on Wall Street there. Another one that people tend to come across is like Rich Dad Poor Dad, which is more like about by building up your assets column. Yep. If you remember that, there's like a quadrant in there. Where
my dad made me read that when I was probably late primary school, I think, and we had the board game as well. He's gone on to do a few other things now, which are quite eyebrow raising. But then we've got this is probably the most popular book in your community, I'd imagine. It's definitely in ours. Yeah, Scott Pape's book. Pearler got a mention in Scott's email a little while ago. Yep.
Claim to fame, mate. Claim to fame. Another one that people probably haven't read, and there's a few bookmarks in this one, is a Tony Robbins book called Unshakable. And this is about building it's just as much about psychology as it is about just as much about psychology as it is about the actual technical specifics of investing. And then finally, the one book I'm going to bring up here at the end is The Psychology of Money, which is probably the perfect accomplice to the Barefoot Investor book for those that haven't read it. Yeah. It's just all about psychology and whatever. And
both of which, just to be clear, have been huge inspirations and quite literal influences on the platform.
Yeah. And for you and for users of Pearler as well, right? Like the community at large. And that, these books, I think, maybe say the difference with the one up on Wall Street, which is a bit different because it more talks about investing in individual companies. But the major books are all coming back to some very simple things. And I might just share my screen really quickly again, which is just here. You can see this, right?
Yep.
So there's this book. Have you ever read this book, The Richest Man in Babylon?
I haven't read it.
Okay, so it's this one right here. This is the copy that I've got. Just wait for that to load real quick. But this book was written, I think it's 95 years ago now, and it's a fantastic book, and it basically takes you as it's almost like a setting in ancient Babylon where where you're set as the narrator, looking at a person who owes their family money, who wants to build gold or wealth, who wants to save a little bit more every month and wants to pay down their debts and invest in a portfolio that they understand and all these things. And then you can trace basically, I think it was like the 1920s this book was written, and you can basically trace back every single personal finance book written since then back to that same thing, the same principles in that book. And like these are the timeless kind of like, I guess, principles of wealth creation. I tried to summarize them in the blog post, but basically, some of the things that you would do is like spend less than you earn. I think that one of the things that is powerful about auto invest, if I can just riff on this for a sec, is if you think about your investment or your whole income and your whole wealth as like a jar, and there's money going into that constantly, the most efficient way to maximize what's in the jar, the space that's available, is to put the big things in first. And most people, when they put like things in their jar, they start with like mortgage, or they start with like nights out or whatever, right? But the one thing that should go in there, we know, is investing, long-term investing. And auto invest basically short circuits that, because it says we're going to put investing in first, regardless of if there's a compulsion to go and do something else. The money's going to go in on payday. Yep. So I think that's like, just again, like it's hacking our brains and putting the most important thing in the jar first. I feel like that's worth a mention.
Yeah, no, absolutely. And it's actually, there's two very, very specific kind of values to it for us. So you're sort of talking to the idea of pay yourself first, or and then live on the rest, right? So that is absolutely it. But then let's just say you're super disciplined as a person and you go, I don't need that, which is fine. A lot of people do it manually. Then you come to this other set of hurdles, right? So you've got the money, you're ready to do it. And you know that you're going to go and invest in this same thing, whether it's an ETF or a company you like. Then you've actually got to go through the process during your workday or whatever, transfer the money, then log in, then into the market. Are you going to do it today? Should have done it yesterday. And you go through this, even if it's really subtle, there are all these mini barriers to doing it. And that's just because someone decided to make the stock market like that however long ago, and someone decided to make online broking like that however long ago. They're like, well, yeah, an everyday person should be doing this kind of quasi, stockbroker experience like you see in the movies. And the reality is, if e-commerce has made it easier to buy stuff, why shouldn't we as an industry making it easier to invest and take away the friction,
You see, but a lot, I could say that's probably fair. A lot of the modern firms that have tried to do it have tried to gamify it to the point of increasing your tendency to trade because they get paid brokerage, or they're trying to create like, bells and whistles whenever you place a certain number of trades, or give you incentives.
It's also fun though, right? It's not like they're pushing, like you and I agree on this, obviously, but it's you can't begrudge it, because I had fun doing that when I was a bit younger. I wasted money. So it's just more this idea that, the way we think about fintech, let's just say in general, is maybe the last 20 years has been all about technology, making for the retail investor, making things cheaper, faster, and use the word gamified. And at the same time, the wealth industry hasn't really evolved. So advice has gotten more expensive, not less. More complicated, not less. More paperwork, not less. And so your average person who doesn't necessarily get sucked into, or let's say sucked into is the wrong word, doesn't necessarily vibe on, oh, I'm in the market, which is totally fine. They're kind of left in the middle going, I'm going to use this tool that's made for this alpha sort of person who wants to do the thing. I can't really get advice anywhere that I trust or is scalable. And so you're kind of left there going, well, what's the innovation? And so, we think there's not just with what we're doing, but, there's still just so much opportunity to make investing, wealth building more connected to everyday life, more embedded in education, not separate. Like the books you bring up, everyone reads them. It's still just a quantum jump from the book to actually doing the thing. And so technology in the next 10 years, 20 years, really in the wealth space has to be about bringing together the education, the guidance or advice, together with the transactional, to actually help people do better, and that's what we're.
And that's what I was. I think that's where I was going with that point. Is that a lot of people have made it better in a way. They made the user experience better in a way that might actually be to their detriment by making it to a point where it's like, is the kind of the platform that I'm using aligned with my long-term goals? And one of the things that I brought up at the Pearler event, you might remember, is that like when you log in, it's defaulting to 10-year charts. And that's a small thing from a user experience perspective. But what it's actually doing is it's saying, this isn't the daily chart. You don't need to freak out, because most of the investments, if you're in a diversified portfolio, are going bottom left to top right. There's going to be like, seesaws along the way. But that's just another nudge to focus on long-term investing, right? And so because you know that you could quickly take that and you could make it, look, I'm going to trade more often. But philosophically, I think
that brings us back to your original point. Like we started talking, I think, about checking your app. And I think we quickly got on to it's okay as long as it's not creating negative behavior. And that what you point out there is exactly why, right? So it's okay to look at your net wealth. That's inspiring.
For sure it is.
So, and you're not liquidating your net wealth today. So what does it matter? But you still want to look at it because it's yours. So it's a nice circle,
It is, absolutely. I'm going to quickly summarize these 5 things. So I've said automate your regular contributions. These are on the Pearler blog, which we can put a link to. And the second thing was understand that your greatest advantage as an investor is understanding your behavior. And I think this applies whether you're investing in shares, whether you're investing in super, whether you're investing in ETFs, no matter property, whatever. Yeah, understand yourself and what's right for you. You said like lifestyle before. You can see that doesn't matter the amount of income. You can still see people practicing the right kind of like, I guess, behavior, which is important. Number 3 was I said maintain a diversified but low cost portfolio. It can be spread across anything. Like I imagine most people have a mix of Aussie and global share ETFs. I don't know, maybe this is something we can dig up and come back to in time. It's like how much have Pearler users invested in bond ETFs? That might be interesting. I don't think there'd be as much.
Yeah, at the moment, it's not a huge part of it. But I think what people probably have been more interested in, which isn't bonds, obviously, but it's definitely a cohort that sees the value in more the high yield or dividend harvester style ETFs, as an example. But to be honest, the skew is heavily towards just pure equities, and if we look through whether they're listed on the Aussie exchange or the US exchange, you would say that Aussie shares are probably in the 40% bracket, and that global US shares, predominantly US, make up the balance. A lot of those people are investing in through the ASX, obviously.
Yeah. Okay. Number 4 is, and this is one that's kind of been impressed upon people recently, the hard way, which is never invest money in the stock market that you need in the next 3 to 5 years. Like I know a lot of people would use investing as a way to save for a house deposit or for whatever. The key thing is that what we've experienced over the last 6 to 12 months has been hard for a lot of investors, but in some ways it's also typical of the stock market. So if you plan to buy something at a set date in the future, plan for that accordingly. And build wealth outside of direct shares. Number 5, and this is the last one, which is just set some financial goal and stick to it. You don't have to use the word goal. You can use whatever. Like it can be, like you said, how inspiring it can be to track your net worth before. Like just try and do it and see if you every 6 months just revisit it. See if you're getting ahead. I think it gives you a purpose. I think like I as I said before, I'm not much of a goal setter insofar as like writing down my goals on a piece of paper. But what I do a lot is write down why I'm investing. I do that with every investment that I make. It really helps me understand why I made the investment, and also how does this relate to everything else that I've got going on. Yeah, those are the 5 things, 5 kind of like money lessons, if you like, but they're not new. They're like, I haven't invented them. You haven't invented them. These have been around for a very, very long time.
And you didn't mention a financial metric in there at all. So I think that's probably
no price earning ratio. Yeah, no dividend yield, no complicated charting software, no nothing. It's really simple. And, I've been doing this a long time, and it comes back to like behavioral things that have the most impact on people's wealth.
Yeah.
So I think we're just going to keep seeing that play out. Hey, before we let you go, before me and viewers have to wait for you to appear somewhere else, what's on the roadmap? What are you working on? Tell us.
Working on a lot, actually. I mean, I don't want it to appear like a giant plug for Auto Invest, but we launched in March 2021 into a full public product, and Auto Invest was kind of like our baby back then. So we're probably a month or 2 away from launching what is V2 of Auto Invest, and some of the things we've been working on there are right in the mechanics of trading, how to make it more flexible, save you money, how to embed it with calculators to try and help you figure out how often you should be investing to optimize costs. But then what we're also doing is actually looking outside of your investable wallet and trying to, again, just that whole premise of connected to everyday life. So, there's this idea that you start with your buckets. With our technology, we're actually moving probably towards a point where there's a point in the future where you might get 100% of your salary popped into there, distributed to shares, micro, super, back to a savings account, to a checking account. We're really digging deep on how to help you automate your spending and saving, but take it away from, the bank apps, which are now really going down the path of let's integrate with that whole buy now, pay later, smoothing spending, early access pay, then integrating that into e-com. So it's really interesting. We think it's a really interesting trend around how the banks are really turning the bank account into this spending account. We want to see if we can go the other way. We're also working on something in super, which is really interesting. It's not a super fund, but it'll be something around education and finding super and rolling over super. Really exciting. And, I wouldn't say it's quite on the roadmap, but we are really asking ourselves hard questions about how, if 30-40% of our investors also have crypto, how we can maybe engage them in a bit of a different conversation about crypto, whether it's diversifying out of it, maximizing, capping their exposure to it, really looking at a portfolio holistically. So lots going on, and that's before we even get to education, social connectivity, learning from the community. There's lots happening.
Yeah, it's exciting. And this whole time when we've been chatting, you've kind of confirmed a lot of things that I see coming on the horizon. I don't know how they're going to take shape. I think this is kind of like where your job and Hayden's job is kind of focused, is like the way that we access investing is going to change. I believe it's already changing rapidly. And I think, we can look across the world, we can look here in our own backyard and see how quickly things are evolving and how different parts of the investing process is now changing.
Yep.
And it's changing in a big way. And that's exciting, mate. It's challenging for you guys, like in terms of like what you've got to keep your eye on, but it's exciting.
Well, there's a couple of decades, for people our age, I guess, and then even longer for the really wealthy people, the boomers. But we reflect on this a lot, and you kind of even sit there and go, why does it just make sense apparently for Big Four bank, where you've got a savings account, to have a totally separate share trading account? And you kind of probably I reflect on this a fair bit, and I go, it probably goes back to a day where they're like, well, we can sell to that customer, but let's keep it separate, because if we keep it separate, we could probably charge them more in total. And it really goes back to this stage of like, keep them engaged in the brand, but squeeze them for all of the revenue possible. So, and again, that obviously that's something we're watching closely, and we really think the future of wealth building in general is not this wealth thing that sits off to the side of your spending and saving. It's actually at the core of it, right?
Yeah, that's what we've been talking about. I like it. Mate, heaps of fun. I know you're about to go off. Where are you going? You're going surfing?
I am going surfing, Sumatra. So nothing but surf and coconuts.
I like it. Well, hopefully the coconuts keep your energy up and you can enjoy some waves, and then you can come back and you can get stuck into the innovation of the new financial year. Mate, it's a pleasure to always chat. So head to pearler.com if you want to find out more about what Nick and the team are doing. And don't forget to follow us on socials, and just say good day. Mate, thanks for having a chat with me today. I really appreciate it.
Thanks, Owen, and thanks for all of the Rask subscribers.
Yeah, no worries at all.
Helping us do what we do.
Love it.